You bought a stock at $50. You sold it at $100. You made $50 in profit. But before you celebrate, the government wants a piece of that gain. How much you owe depends on what you sold, how long you held it, and how much you earn. This is the complete guide to capital gains tax. The single most important rule in capital gains is the holding period. If you sell an asset you've held for less than 1 year, the profit is taxed as ordinary income, the same rate as your salary. For someone in the 32% tax bracket, that means nearly a third of your profit goes to taxes. But if you hold that same asset for more than 1 year, you qualify for long-term capital gains rates, which are significantly lower. The difference between selling at 11 months versus 13 months could save you thousands of dollars. The clock starts the day after you buy. Here's one of the most powerful provisions in the tax code. If your total taxable income, including your capital gains, falls below certain thresholds, you pay 0% on your long-term gains. For 2025, those thresholds are approximately $48,000 for single filers and $96,000 for married couples filing jointly. This means a retired couple with $50,000 in Social Security and $15,000 in long-term gains could potentially pay nothing on those gains. It's completely legal, and millions of Americans qualify without realizing it. Above the 0% threshold, most Americans pay 15% on long-term capital gains. This is the rate that applies to the majority of investors, from middle-class families to upper-income professionals. The 20% rate kicks in only at very high income levels, roughly $518,000 for single filers and $583,000 for married couples. Even at 20%, the long-term rate is still dramatically lower than the top ordinary income rate of 37%. There's a hidden surcharge that many investors don't see coming. The net investment income tax, or NIIT, adds an additional 3.8% on investment income for individuals earning above $200,000 or married couples above $250,000. This applies to capital gains, dividends, rental income, and interest. So a high earner paying the 20% rate on long-term gains could actually owe 23.8% total. This tax was introduced under the Affordable Care Act, and it remains one of the most commonly overlooked taxes on investment income. When an investment loses value, most people see it as failure. But the tax code sees it as opportunity. Tax loss harvesting means deliberately selling losing investments to offset your gains. If you made $20,000 in gains but also have $10,000 in losses, you only pay tax on the net $10,000. And if your losses exceed your gains, you can deduct up to $3,000 against your ordinary income each year, and carry the rest forward indefinitely. The wash sale rule prevents you from buying back the same security within 30 days, but you can buy a similar investment immediately. Smart investors harvest losses every year, especially in December. Real estate capital gains are a different beast entirely. First, there's the primary residence exclusion. You can exclude up to $250,000 in gains on your home if you're single, or $500,000 if you're married, as long as you've lived there for at least 2 of the past 5 years. For rental properties, the rules get more complex. You've been depreciating the property over the years, and when you sell, the IRS recaptures that depreciation at a rate of 25%. Then there's the 1031 exchange, a powerful strategy that lets you defer capital gains entirely by reinvesting the proceeds into another investment property. You don't eliminate the tax, you defer it. But many real estate investors use 1031 exchanges repeatedly over decades, effectively never paying the tax in their lifetime. Not all capital gains are taxed the same. Collectibles, which include gold, silver, art, wine, antiques, and stamps, are taxed at a maximum rate of 28% on long-term gains. That's higher than the standard 15 or 20% rate for stocks. Cryptocurrency follows standard capital gains rules, short-term gains taxed as ordinary income, long-term gains at the lower rates. But every transaction is taxable, including trading one cryptocurrency for another. The IRS has significantly increased its focus on crypto reporting, and starting in 2025, exchanges are required to report your transactions directly to the government. For strategies that can save you thousands every year. 1. Hold investments for at least 1 year to qualify for long-term rates. 2. Harvest your losses to offset your gains. 3. If your income is low enough, take advantage of the 0% bracket by realizing gains strategically. 4. Plan ahead. Know your brackets, time your sales, and work with your overall tax picture. Capital gains aren't something that happens to you, they're something you manage.
Money Unwrapped. See you next time.